You're listening to the Option Alpha podcast from OptionAlpha.com, where we show you how to make smarter trades, learn how the stock market really works, and generate consistent monthly income. Now, your host and head trader at OptionAlpha.com, Kirk Duplessis.
Hey everyone, this is Kirk here again from OptionAlpha.com, working every single week to make this the most popular podcast offered online in iTunes because it's based on one thing and one thing only, and that's helping you guys make smarter trades. So thanks so much for tuning in today. We've got an awesome episode for you guys today talking about covered calls. And I think that if you're even new to options trading as a stock trader originally or any type of investor, I think some of the case studies that we're going to present in this podcast are going to really blow your mind and kind of change your way of thinking as to how options can be beneficial, even if you've never traded them before. Even if you're a stock trader and you want to do something like a covered call, hopefully I'm going to blow your mind with some real examples during our closing bell segment, where we use some real figures and real numbers from today's trading to show you the power of using covered calls in your portfolio. So just to kind of go through what we're going to go over today in the podcast, first, we're going to talk about what a covered call is, right? So we're going to break down kind of, how you build it, what the mechanics of a covered call is. And then we're going to talk about when you would use them. So what are the types of situations that you would use them? And I'll kind of share an example of one that I've done before consistently in a stock that I'm really well invested in. And so it's a great example of how I've personally used it, and I kind of practice what I teach here. Then we're going to talk about the challenge that I have for your financial planners. And we're going to dig a little bit deeper into this challenge, and I want to get your help in engaging with financial planners that you have or that you know that are in your circle of influence, and how we can better help educate this entire industry on the power of options trading. And then we're going to talk about covered call alternatives. So if you don't have the capital or don't want to use the capital to do a covered call, we can talk about some different ways to do them without using so much of your capital. And then finally, in the closing bell segment today, we're going to look at an awesome case study with Netflix, which is a big name stock. Everyone likes to trade Netflix, but a great example of how you can use covered calls to reduce your risk, increase your potential chance of success, and reduce your cost basis in a stock. So we've got a lot to cover today. It's probably going to be a little bit longer episode, so stick with me here. And then before we start, again, I just want to ask you that if you haven't had a chance to go to iTunes and leave a review, please do that today. You can do it on your phone or on our website at optionalpha.com/podcast. But I get literally hundreds of emails every day from people who are starting to listen to the podcast, which is awesome. And I keep asking everyone, just go to iTunes and write a review. That's the best way you can thank me for listening to this podcast. And I do appreciate it. I know that everyone listens to it when they're changing diapers or going to the gym or at the grocery store, which is just really cool. So I know that it's been great, and it's definitely been a good tool for me to engage with you guys and get questions and answers and all that. All right, so let's dive in here and talk about what is a covered call. So when most people get started with options trading and they kind of make the jump between stock trading and options trading, the first strategy that they learn is a covered call. And I don't fault anybody for doing that. I think that that's probably the easiest way to transition, because it's a compilation of options and owning an underlying stock. So a covered call is basically when you actually already own a stock position, and we'll just say, just to make numbers very easy, you own 100 shares of whatever stock it is. So let's just say you own 100 shares of Ford Motor Company. Now, you could just keep this stock and continue to hold it, and so you'll make money if Ford goes up and you'll lose money if Ford goes down. Or you can employ a option strategy that will help to increase your chance of success and reduce your cost basis in the actual stock that you own, like Ford. So what a covered call does is that it takes that stock that you own of 100 shares and it uses those shares as collateral for a short call option, which is going to be above the market. So in this strategy, what you're going to do is, let's say that you own Ford stock at, say, $15, and you're going to sell a call option at, say, $16. So you would sell a call option at $16, which is above the market, and the collateral for being able to do that trade is the actual stock that you own at $15. Now, what would happen is that if Ford stays right here at $15, well, then you keep that premium that you sold when you sold that option at $16. So if you took in 50 cents of premium or $50, you would keep that additional premium because Ford never went from 15 up to 16. If Ford goes from 15 and it goes up through 16, then you would lose any money beyond your break-even point, which would be 16 plus the credit that you received of 50 cents. So I'll say it again. So Ford goes up beyond 16, it goes up to like $17. You would only lose money beyond your break-even point, which would be the price or the strike price of the call that you sold, which is 16, plus the credit that you received, which is 50 cents. So anything beyond $16.50, you would actually not lose money, you just don't make any money. Okay, so maybe that's a wrong way of saying it. You don't lose any money beyond that point, you just don't make any money. You don't participate in the benefit of the stock going higher. So if you did this strategy and let's say tomorrow Ford announced it was getting bought out by GM or whatever the case is, then Ford shot up to $30. Well, you would only make money from 15 to 16 and a half. You wouldn't make anything beyond that. So that is one of the downsides to doing a covered call. That's one of the, I guess, the major drawbacks that people don't want to do it is because they lose that upside potential. But what I'm here to tell you is that in the world of trading and investing, one thing continues to hold true in nearly all cases, and that is that when you reduce your upside potential or you limit your upside potential, you increase your chance of success. And that's found virtually in every strategy that you can find in the options world. So in this case, when we give up that potential for massive, massive success and are okay with taking a smaller but still reasonable gain, then you actually increase the chance of success on that entire investment. And it's like making a lottery bet, right? Like if you go out and buy a lottery ticket, you have very little investment and you have a huge upside gain. But nobody really wins trading lottery tickets or buying lottery tickets. And the same thing happens in the stock market, is that if you continue to hold the stock, yeah, you have that opportunity where the stock could go, through the roof, but is that really going to happen all the time? Are we all that lucky that we can pick stocks that way? No. And in fact, tons of research has shown that that's never the case, that no one can pick stocks consistently in the right direction. And so with a covered call, that credit that you receive, in this case with the Ford example, of 50 cents, that helps reduce the cost of the shares that you bought down to $14.50. So now, even though you actually bought shares at $15, by selling that naked call option at 16 and taking in a credit of 50 cents or $50, that has reduced your cost basis on the stock to $14.50. Now you can see why this increases your chance of success, because if Ford stays right here, you actually make a $50 profit and the stock didn't move anywhere. So Ford stays right at $15, you make an extra $15 or an extra $50 and the stock never moved. If Ford goes up to $16, then you still made money between 15 and 16, plus you still kept that premium of $50 that you got when you sold the 16 calls. So you still make more money during that time period. And now the best thing is that if Ford actually does go down, and let's say it goes down to $14.75, well, you still made money because your cost basis on the shares is only $14.50. So if Ford trades down, you actually might make money with a covered call because of the credit that you took in. So it really is a great strategy, because even though you're giving up some upside gain, and we have to factor that in, and we're going to look at that a little bit later in the closing bell with Netflix, but even though you're giving up some of that upside gain, you really have to understand that by giving up that upside gain, you're actually increasing the likelihood that you're going to make money at all on the position. And that's much, much more important when it comes to trading and investing than the potential for a 3,000 or 5,000% gain in the stock price. Okay, so it's a really, really good strategy. Now, when would you use a covered call? Well, I've got two examples that we can go through. And I think the most general example of when you would use a covered call is on a stock that you like, that you want to own long term, and you want to use that covered call as a way to reduce the cost basis on that stock that you own long term. And I think a really good example of that is a stock that I own that's called Realty Income. So I own a stock that I've owned for a long time now. It was a stock that I used to cover way back in the day when I was an analyst, and I really, really like the company. They pay a very good dividend in the stock, and so it's a great stock to own, and it's, again, Realty Income. It's a REIT, and the ticker symbol is just O, so just one letter O. But I like the stock long term, so I don't really want to give up the stock, but I do want to continue to reduce the cost of owning the shares of that particular stock. So what I've done over the course of a year is I've continued to sell a call against the options or the stock that I currently have. So I own about 200 shares of stock in Realty Income, and it's not a lot because I'm not a huge stock investor, but I like the dividend that it pays. And throughout the year, I've been able to sell a call option and consistently take in a little bit of income from just the actual underlying value of the stock. So, for example, back in April, I was able to sell a call option about $1 above where the stock was trading, and I took in an extra 40 cents of premium that helped reduce the cost basis on the shares that I owned down another 40 cents. And I did the same thing with taking in a 50-cent credit in August, and the same thing in September and October. I took in all of these credits. And over the course of the year, just this year alone, I've been able to reduce my overall cost in the stock by more than $3 by doing this type of strategy. So that has helped me. So now wherever the stock is, I've actually got an extra $3 of buffer room because of using this type of covered call position that I have in Realty Income. And it's a great way to supplement a stock that you want to own that is in your portfolio, you like long term, but why not reduce your cost basis on that stock along the way? Okay, and so that's a really good example of something I'm doing right now. I'm kind of practicing what I'm teaching. Now, I want to talk about my big challenge for you and for your financial planners. So I know for a fact that almost 99% of financial planners out there won't touch options. And you could probably even ask your financial planner why they don't touch options, and they'll tell you that it's risky. But what I want to do is I want you guys to send this podcast or the show notes, which you can find at optionalpha.com/show12. Send this podcast or this show notes to your financial planner and then ask them, after listening to this and after researching what a covered call is, why they are not using it as part of their financial plan for you. So I know a lot of financial planners will invest in stocks and they think diversified stocks is kind of the end all, and that's fine, but why not use options as a way to supplement some of the positions that you have long term, again, capping some of that upside gain to increase your chance of success. And sometimes when people hear capping that upside gain, they think, well, I'm only going to make 1 or 2%, so I don't want to settle for that. But later on in the podcast, when we get into the closing bell, I'm going to show you with a live example with Netflix that you can actually cap your upside gain to 10 or 12% in 1 month. And so if you make that gain in 1 month, aren't you satisfied? Wouldn't 10 or 12% in one single month be enough? I mean, the stock market returns on average 10% year after year after year, going back, hundreds of years, right? So that doesn't really, 10% in 1 month, that's a phenomenal investment return given that you only took risk for 1 month, right? So we're going to show you a live example of that. But again, I want you to send this to your financial planner. I want you to ask them and challenge them on this, right? They're working for you. You're paying them money. They're managing your investments. Ask them why they're not using options as part of their overall financial plan for you. And if they can't give you a good enough answer, then you need to move to a different financial planner. Because in this day and age, options trading is the wave of the future. It is growing exponentially every single day, every single month. More contracts are being traded. And if they're not learning and evolving with the industry, they're going to be left behind. And you need to find someone who is going to watch out for your money just as good as you are. Now let's talk about some covered call alternatives. So by no means is the covered call strategy very easy to get into because it requires a lot of capital. And so you have to buy the actual underlying shares, which is going to tie up a lot of capital, and then you can sell the call option against them. So one way that you can go ahead and get into a very similar type strategy with a covered call is to buy a synthetic long in an option or using options. So you can do what's commonly referred to as a collar in some cases, or a synthetic long of the actual stock. But we'll still use that Realty Income stock that I was talking about earlier, and we'll kind of use an example with that. So currently, Realty Income, again, ticker symbol is O, is trading for about $45. And right now, you can buy the shares, which you would have to have 100 shares of the stock, so $4,500 to actually control 100 shares of that stock and go long the stock. But if you don't have that kind of capital that you want to tie up into one trade, or you just don't want to tie it up in any trade, you can do what's called a synthetic or a collar around that security. So in our case, we could do the 45, we could go long the 45 calls and go short the 45 puts. So again, you're going long a call option at the same strike price as you're going to go short a put option. And what this is going to do is this is going to make you synthetically long the stock, and it's going to act as if you own the stock outright. You're going to control the same amount. You're going to have virtually the same profit loss as if you own the stock outright. And the cost of doing that is only $40. Now look, this creates an opportunity for people to get very, very over leveraged in their account. They see this opportunity where it's, I could own the stock outright for $4,500, or I could use $40 and be synthetically long 100 shares of stock. You're using almost 1% of what you would originally in $4,500. So you're really, really leveraged. And I just want to make sure that you understand that you can be obviously over levered, and you don't want to do this in everything because you still have a ton of risk if you do. But it's a great way to get synthetically long a stock that you really like, and with very little capital out of pocket. So in our case, again, with Realty Income, which is ticker symbol O, we can get synthetically long by buying the 45 call and selling the 45 put at the same price that the stock is trading at right now. That cost to us is $40, which is just 40 cents in the actual option trade. So for $40, we can get long 100 shares of Realty Income. And from there, we can go ahead and do the same thing we did before, where we sell a call option against that. So in the case of Realty Income, we could go ahead and sell the 50 strike call options for about $1. So we could take in an extra $1 that reduces our cost basis on the stock. And now if Realty Income goes from 45 to 50, we make that money, but nothing beyond really $50. Okay, so it's a really good example, and again, a great way to use the power of options to replicate what stocks can do with less capital and using that leverage in the market. And again, challenge your financial planner on this. If they don't even know how to do that, if you kind of go to them and say, hey, what if I wanted to get into a stock, but I only wanted to use, maybe 1% or 10% of my capital to kind of replicate that stock position, I would bet that almost all financial planners that are out there right now don't know or don't have a clue how to do this. And again, if they don't, you need to challenge them and ask them to learn, or again, send this podcast to them so they have an understanding of how they can help their clients, kind of reduce risk and increase the potential chance of success for some of the trades that they make. Okay, so we've talked a lot about what is a covered call, how to use them. We've used examples with Realty Income. We talked about the challenge for your financial planner and trying to get your help in educating this industry. And then also just about how we can do this with alternatives. So an alternative to actually buying the stock and using all that capital. So as we get into the closing bell here, I want to talk about a specific example with Netflix, which I think you guys are really, really going to like. But it does require a lot of numbers, so if you need to come back to the show to write down all the numbers, I encourage you to do so. Otherwise, let's get right into it here with the closing bell.
Now, the closing bell. Find out which stocks we're looking at right now, trades we're making, and hear our game plan moving forward.
Okay, so in today's closing bell, I want to look at a very, very specific example with Netflix. So we've looked at an example with Realty Income, which is a stock that I already own and will own for a long time. I love the company, but I want to look at a new example with Netflix. So let's just say that we've got a clean slate and we want to buy Netflix. You're really invested in Netflix. You love what the company is going to do, or your financial planner says you got to buy Netflix, whatever the case is. We're going to look at an example of just buying the stock versus buying a covered call on the stock. And that, again, is Netflix, which is ticker symbol NFLX. So currently, Netflix is trading, as of today, this time of this recording of this podcast, it's trading for $3.43. So it's a high-priced security. So, of course, it's going to require a lot of money to get into that stock. But again, some financial planners are going to use up a lot of your capital to do that because it's a high-growth stock. So it's trading for $3.43 right now. Currently, the 1 month options that are out, which are January, so they're 1 month out, about 30 days out, the 375 call options are giving you a credit of about $5. So 1 month out, January options at a 375 strike price are giving you a credit of about $5 in premium. So if you were to buy Netflix shares at $3.43 and you were to sell the 375 call options, then you would take in a credit of $5 on the sale of those calls. Now that $5 credit helps reduce your cost basis in Netflix from $3.43 down to $3.88. So it's a 1.5% reduction in the price of the actual underlying shares. So I'll say that again. By buying the Netflix at $3.43, selling the 375 call options, that will reduce your cost basis by $5, which gets you down to a net cost of buying the stock at $3.38. So now, if Netflix goes down from $3.43 down to, let's say, $3.40, goes down $3, well, you still make money because your net cost basis on these shares is $3.38. So if Netflix goes down to $3.40, you still make money because of the credit that you took in from that call option. So you see how now you understand the power of selling a covered call. It helps increase your chance of success because now the stock can actually go down and you would make money on the trade. If Netflix went up to, let's say, $3.50, then you would still make money from where you bought the shares at $3.43 up to $3.50, plus you'd get to keep that extra $5 of premium that you sold from the 375 calls. So you can see that it still maintains that upside potential reward. Now, what everyone always says is that covered calls reduce your upside gain. But with a little bit of digging deeper into probabilities of different strikes in Netflix, we know right now, based on the entire trading history of Netflix, that the likelihood in the next 30 days, which is the time frame of this trade, the likelihood in the next 30 days that Netflix gets from $3.43 up to $3.75, which is where you start to give up some of your gains, you don't make any more money, that likelihood of Netflix getting up there is only 20%. So what that's saying is that there's an 80% chance that Netflix never gets to $3.75 between now and January expiration. So in the next 30 days, you've got an 80% chance that you're going to keep this $5 credit and reduce your cost basis on this stock by $5 80% of the time. You make the same type of trade over and over and over again, you're going to reduce the cost $5 80% of the time. Now again, this is where a lot of people come in and say, well, what about the upside gain? Well, let's say that Netflix does go beyond $3.75 and goes well beyond $3.75. Well, that means that you then give up all of your gains above that level. And that means that if you bought the stock at $3.43 and you reduced your cost basis to $3.38 because of that $5 credit, if Netflix goes beyond $3.75 and you give up all of your gains at that point, you've made an 11% return in 30 days. So the difference between $3.75 and $3.38 is an 11% return in 30 days. And I don't know about you, but that still leaves you a ton of upside potential in this stock. Now again, this is where you need to go back to your financial planner and show them these numbers and say, Mr. or Mrs. Financial Planner, what is it about a covered call that is so risky? In this case, with hard numbers in Netflix, we would reduce the cost of owning the stock by 1.5%, meaning that we could make money even if the stock goes down. And we still keep an opportunity to make 11% in 1 month. So if Netflix does go higher, which is great, that's a great opportunity, we still make 11% on that move up and have reduced our cost basis in the process. Now, what's even better about this type of strategy is that this is only looking at one individual month. This is only the January options for Netflix, which are 30 days out. If you were to replicate this strategy over and over and over again, you could conceivably keep reducing your cost of owning Netflix by $5 every single month. So if the stock never went higher than $343, you could keep reducing your cost basis down $5 every single month. And that only is going to make you more successful if the stock does turn higher. And so that's really the power of doing covered calls, is this ability to, again, keep the upside gain. You limit it. You don't have unlimited gain potential, and you do limit your upside. But in the case of Netflix, we limit it to an 11% return in 1 month. I think that most financial planners would be very happy with that. And I'm sure you would be very happy with that if you could do that every single month. So that's a really good example using Netflix. And again, I hope that you challenge your financial planner and whoever you use to manage your money and kind of invest your money as to why they don't use this type of strategy with you already. And if they don't, you be the one to educate them, show them, write out these numbers, show them a trading diagram as to how a covered call can help them, because that's the only way that we're going to get a lot more people engaged in options trading and help kind of turn this industry around and make it more successful for the retail trader like you.
Thanks for listening to the Option Alpha podcast. If you liked what you heard, please drop by iTunes and leave a rating or comment. Plus, you can get everything: free email updates for future shows, transcripts, video tutorials, case studies, and more. Just visit our website at optionalpha.com.
All right, I truly hope you enjoyed today's show and got at least one thing out of it that you can apply right now to make you a smarter, more profitable trader and investor. And like I said earlier, hopefully you guys can understand now the power of just combining options and stocks together. I think the options are incredibly powerful, and you wouldn't be listening to this podcast if you didn't think options were powerful. But now you can see just the possibility of using them in conjunction with current positions that you own and current stocks that you like. Now, as always, you can find additional show comments, video tutorials, and mentioned links that we talked about here today on the show by going to optionalpha.com/show12. That's just the number 12. So optionalpha.com/show12. And until next time, happy trading.